It has not just been a bond rally, it has been a bond stampede. It has not only been in the U.S., it has been around the world. What's driving it? Is there a message here, a signal for the Fed?
Well, the yield curve and bond yields globally really are indicative of skepticism about the prospects for future growth. European growth is slowing, Germany, Italy. China, although may appear to be stabilizing, but their underlying growth has been sluggish. And the prospects for U.S. growth are a little bit more sluggish in 2019 than they were in 2018. We'd been expecting all through 2018 the growth would slow. It's now happening. We're not sure how much. I'm not sure how much growth is going to slow, although my best judgment is we're going to slow down to 1 3/4 to 2% growth. But I think the bond market's suggesting that it could be a little worse than that. We'll have to see. But that's really what you're seeing in the bond market is skepticism and sluggish expectations for future growth.
Well, it's interesting, Rob, that this bond rally really seemed to get started after the FOMC met and took all the 2019 rate hikes off the table. Moves can be in either direction. The bond market has increasingly now started pricing in the chance of at least one rate hike this year. Is that a possibility, or is the bond market getting ahead of the Fed?
Yeah, and I'd emphasize, I'll give you my own view. I didn't, in my dot plot, and I've been saying this for some time, I didn't have any rate increases for 2019. It doesn't mean that I couldn't change my mind. It means as I sat there in the March meeting, that was my base case for 2019, but it's always subject to change. And so what my main goal is for monetary policy right now, and the stance of policy, is that we're flexible and that we are patient, and that I want to see how growth is going to unfold for the next several months in 2019, and based on what I see. And for me, I look not only at the economy hard data, I look at corporate earnings reports, I look at a whole range of factors, I look at what's going on in the markets, particularly the fixed income markets and the Treasury curve. And based on all that, as we get through and later in the second quarter, I want to be flexible enough and have a stance, a policy, where we can move appropriately. I don't know where that will be yet. Could be no action at all, but I think we're well positioned right now to take the appropriate move based on how the facts unfold.
What would be a trigger for you to say, looks like maybe it's time to think about cutting rates and maybe even pull that trigger?
So for starters, I've said our base case at the Dallas Fed is that GDP growth for this year is going to be a little bit below 2%, in the neighborhood of 2%. And I have some confidence because we were saying all through 2018 that we thought growth in 19 was going to slow meaningfully. It's turned out to be a little slower than we thought in 19, but if there was evidence to suggest that growth would actually undershoot that forecast, and there's a number of uncertainties. Fiscal stimulus is waning. We've got all this trade uncertainty. We've got European growth decelerating. We've got issues with China. We've got a long list of uncertainties. If I saw growth, if I started to believe the growth prospects were going to be below that base case forecast, then I'd start thinking about what does that tell me about the stance of policy. In talking to me, what I've been saying for the last couple of years is I don't think the Fed should be restrictive in monetary policy in our stance, but I also felt we're getting to the point through 2018 and even up to now, I'm not sure we need to be accommodative either. I would say our stance right now is that we are just mildly accommodative. We're in the neighborhood of neutral. Neutral is an amorphous concept. It's uncertain. And so if I saw some slowing beyond our base case, which told me maybe we have a tighter policy than I thought, that would get me to say, let's revisit policy. And in that regard, the yield curve is one of several indicators I'll look at making that judgment.
So you are watching it closely. It did invert the 3-month bill to 10-year note, which is the Fed's favorite usually. Many Fed officials say that.
I'll comment on that.
Okay. It has uninverted just a little bit, but bottom line, it's very flat, whatever curve you look at. How strong of a signal is that? And let me just add that of all 7 recessions in a row foreshadowed or at least preceded by an inverted curve.
Right.
One time the curve inverted and it didn't cause a recession, but that was back in the early 60s when the Fed started cutting rates aggressively, preemptively. And I think that's the question for the Fed as it looks at these curves.
So I've been someone who's said all along, an inverted curve of some magnitude and or some duration, I think is significant and something I'll watch. We don't have either yet, by the way. So just to remind people, the 3-month T-bill versus the 10-year is basically flat, 240s versus 240s. The 2-year is around 220, and so that 2 years to 2s to 10s are upwardly sloping. I think the part that is inverted is the 3-month to the 2-year and the 3-month to the 5-year. I pay attention to that. But in particular, I would need to see an inversion of some magnitude and or some duration. A few basis points one way or another, or something that moves for a few weeks is not the trigger that I'm looking for. And here's the reason. Here's the reason why. The reason, it's very important to talk about the reason I think the inversion matters. For me, the signaling is less significant because there's a lot of changes in the world, including lots of global liquidity. The thing that is significant is what a meaningfully inverted curve does to credit creation. Mm-hmm. That's why I'm interested in this. And in particular, if you can't borrow short and lend long and make a spread, or if the curve gets where you're paying more to borrow short and you're getting less to lend long, it historically has meant, and I think it would mean, that it would create some impediments for credit creation. There's a reason normally these recessions happen with a lag after the inversion. It's because I think credit creation starts to get impeded. Mm-hmm. And we know if credit creation and financial conditions tighten because of it, yeah, that would lead to a slowing, but that's the reason I'm interested in inversion. A flat curve in and of itself, or flat-ish, which is I think what we have right now, may not necessarily be that significant. So what I'm watching for is, again, an inversion of some magnitude and some duration. Okay.
Inflation might have something to do with what bonds have been doing,
yes,
with what the curve has been doing.
Yes.
And we got some very interesting data on inflation today because we see the Fed's main measure. They look at the headline on the PCE deflator. They look at the core, which takes out food and energy. Now, the core, which has been pretty much close to 2, is back down to 1.8. The headline has fallen to 1.4. And is there a concern at the Fed that it has not yet sustainably reached that 2% level? And is that another thing that inclines the Fed, if anything, not towards hikes, but eventually some more ease?
So I'm one, as you know, who's been very vocal about why we might be running behind our 2% target. And I've also been vocal that I don't think inflation's running away from us. And I've also said, and I'll say it again today, with 3% growth last year and this tight labor market, if we're struggling to muster inflation even at 2%, it tells me that if we slow, you could have some deflation, or have inflation readings that are even further behind 2%. Now, why is that? Some people say because there's more slack in the labor market than we might have thought. That's possible. Second, maybe inflation expectations have broken down a little bit. That may be a factor. For me, the third factor is significant, and we spend a lot of time on this, and we do conferences on it at the Dallas Fed, including one in May. For me, technology-enabled disruption and the structural changes in pricing for businesses is not talked about enough. And what do I mean by that? All of you live it in your lives. Businesses have less pricing power today than any time in my lifetime. Why? Consumers, all of you and all of us, have in the palm of our hands more computing power than most companies had just 15 years ago. We take it for granted, but that's a big deal. So what happens is consumers are able to shop for the lowest price using technology. And so in addition, what companies are doing, investing more in technology in order to address their lack of pricing power. And in addition, new models. Think Lyft, think Uber, think Airbnb. You can go through the whole Amazon, obviously. New models are being developed that are disrupting old models that provide lower price and greater convenience. And so you wrap all that up together, you go industry by industry, there is a lack of pricing power. It's structural. It's not cyclical. This is a structural change. And so it doesn't surprise me that these inflation readings, and I've been saying this, and we've been saying this at Dallas Fed for some number of years, we expected inflation pressures are much more muted, because if you have a cost increase, you can't necessarily pass it on the consumer. Instead, you're more likely to have margin erosion.